Welcome to episode 298 of the Independent Advisors Podcast, where Matt Jessup and Mark McEvely bring you everything you need to know from the past week in the world of financial markets and financial planning. If you're watching on YouTube, it is apparent that Matt and Mark are not present today. Instead, we have one of our esteemed wealth advisors, Aaron Kramer, and myself, Nick Whitaker. Matt and Mark are away on business, but we'll be back soon. As always, we will quickly review month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and is as of the market close yesterday, which was April 30th. The S&P 500 is down 0.8% month-to-date and down 5.3% year-to-date. The Dow Jones Industrial Average is down 3.2% month-to-date and 4.4% year-to-date. The NASDAQ Composite is up 0.9% month-to-date and down 9.7% year-to-date. The iShares Russell 2000 ETF, think small caps, is down 2.3% month-to-date and 11.8% year-to-date. The Vanguard FTSE All-World ex-US Index is up 2.8% month-to-date and up 8.6% year-to-date. The 3-month Treasury rate is sitting at 4.31%. The 2-year Treasury rate is sitting at 3.6%, and the 10-year is sitting at 4.17%. Okay.
Very good.
Yes.
Very good.
So, jumping into big headlines and current events, it's been a pretty jam-packed week thus far, and
April's been a lot for sure, market-wise and news-wise.
And this week will continue to be jam-packed. Huge week for earnings, huge week for economic news. By the end of the week, more than 160 of the S&P 500 companies will have reported their earnings, including some of the big tech names: Microsoft, Meta, Apple, and Amazon. We had Microsoft and Meta report last night, and those earnings were met very well by the market. Generally, everything was very strong. I think those stocks are bidding up right now in the pre-market. It's 9.
They report after the bell?
They reported after the bell yesterday. Okay. And last I looked, I think Microsoft was up 8-9%, and Meta was up 6%. So that's really what's driving the market higher right now. The market's bidding up about 1%. That could obviously change within the day. Yeah. And then tomorrow after the close will be, today after the close, which is Thursday, we'll have Apple and Amazon. So even more big news. I can say generally earnings, just broadly speaking, I would say they've been mixed. Nothing overly concerning. Some hits here, some misses there. But obviously, the big players in the market can really, as we're watching this morning, can really move the market.
Yeah, of course. The Mag 7, right? They're going to move a lot of the S&P because they're so big.
Exactly, because they make up so much of the S&P.
Yes, exactly.
So elsewhere, on top of all this earnings news, and by the way, before I go into the economic side of things, our conversations about those stocks are not a recommendation for or against any of those names, simply just commentary. So on top of all the earnings we've also had a slew of key economic reports this week, and we'll continue to have them throughout Friday. So I'm not going to go through all of them, but I'll just kind of list a few of them. On Tuesday, we had April consumer confidence, a drop in confidence, not surprising. I've got a perfect chart for that. That's great. That's been heavily documented over the past 2 months. Wednesday, we had the April ADP employment change report, which is kind of like a precursor in a way to the monthly jobs report, which is actually going to be on Friday. That was notably weak, which the market did not love. Wednesday, we had the advanced Q1 GDP, which is a decline in real GDP. Notable front-running on tariff measures showed up in a 41% increase in imports. Consumer spending growth was decent. The market didn't love it. And then Wednesday as well, we had the PCE index, which is the Personal Consumption Expenditure Index for March. And for those that don't know, that is one of the heavily relied upon data points for inflation for the Fed, that the Fed likes. So the Fed's preferred preferred inflation metric. And that was generally well met. The PCE index decelerated 2.3% year over year from 2.7%, while the core PCE index decelerated to 2.6% year over year from 3%. So that was welcome. Yeah, that's what we want to see. We'll have the supply management, the Institute for Supply Management PMI index will come out at 10 this morning, and then tomorrow is the jobs report, so the April jobs report.
It's a jam-packed week.
It is a jam-packed week. There's a lot going on. So I think really from the economic side of things, there's some more stagflation worries that you'll probably see some headlines about that, which is really fueled by the GDP print.
Sure.
And at the same time, then you had the PCE come out,
and that, better. It's it's kind of mixed news, right?
It
kind
is.
Of goes hand in hand with those earnings. That some are good, some are bad.
Exactly.
It's a lot of mixed reporting right now.
It is, and it really is this week. And earnings season in general is really like drinking from a fire hose. It's a lot to digest, and so you kind of see these choppy moves in the market. And thus far, I think the markets handle everything really well, especially given the move that we've seen over the past couple of weeks off of the lows. So that was a lot of news. So hopefully everyone's caught up a little bit on that. And I say we jump right into tweets, articles, and research, unless you have any other comments.
No, I think that's perfect. I got a few good ones here. I'll start off with a Xpost by IsabelNet _SA, and this was from April 25th. This kind of goes hand in hand with that, consumer confidence and sentiment news headline. So, Xpost says S&P 500 current low levels of sentiment versus the VIX composite index tend to coincide with market lows, indicating potential buying opportunities rather than the onset of larger market reversions. So if you look at this chart, it's overlaying sentiment relative to the VIX overlaid with the S&P 500 index performance. So if you look at sentiment lows, so the worst times when sentiment, basically when people, the average person, are as bearish as they get, we see
combined with volatility, basically stacking those two data points against each other.
So if we look at some of the worst periods of time, 08, the GFC, 2020, around 2020 with COVID, 2022 with that bear market. If you look at this metric and look out the next year, the market tends to rally quite a bit to the upside. So I think it's kind of almost a contrarian indicator when the feeling that things are so bad. What does the market tend to do going forward? Tends to rally to the upside. So not saying it does it immediately, but if you give it enough time, it appears from this chart the market tends to rally to the upside. So I think it's kind of interesting. The chart shows a bunch of different actions. Bear market lows, debt ceiling. What is the Fed doing? The COVID pandemic, all that stuff. So pretty cool chart. I like it.
Yeah, I think you can even really see it. I mean, you got to really stare at it for a second, but you can see it in the smaller pullbacks too, with like the debt ceiling crisis, and then Brexit. Those are some of the smaller examples.
Yeah, the volatility is not as high, but 2018 sentiment is still lower, right?
Yeah, 2018 is
December of 2018.
A perfect example of looking at this chart and thinking of it as a kind of a leading indicator. So
I like it.
Interesting.
So
this chart should give investors a little bit of the warm and fuzzies.
I would agree. There's, I think, there's obviously a lot of news going on right now with tariffs and a lot of negative news cycles, and I think this is just a little bit of, a little bit positive.
Yeah,
positivity.
A way to kind of flip that on its head in a way.
Exactly. Anything else on that? Or are you good if I jump into the next couple?
I love your next one.
I know. Isn't this great? So this is another Xpost by Bespoke Investments, great research group, put out some really good charts. And this is from April 24th, and its searches for tea times are at an all-time high. And it says, what recession, question mark. So this chart, where does it go back to? 2000, chart goes back to 2004. And it's kind of this, I love the seasonality of this.
Oh, yeah,
because
for sure.
it's like wintertime, no searches. Summertime, spring, the searches are just like this constant peak. So I don't know. This is, I think, a signal of consumer confidence in a sense. People are willing to spend money. Golf's not cheap.
It is not.
My experience, golf is anywhere from $60 to $100 a round these days, which is kind of crazy. So,
and that's if you're not losing a couple of sleeves
yeah, it's
of
not if you're
balls
losing
while-
balls and buying gear and all that stuff. So, I think this is a positive indicator for the consumer. So,
Yeah, absolutely.
In my opinion, people are still out spending money. That's a good thing, especially in the U.S. economy. So we're consumption based. We need, these service industry type jobs and spending habits to continue. So
Absolutely.
I think that is a wonderful sign for the economy, in my opinion.
Yeah, it's
Not a good sign for getting tea times in advance, but
yeah, if you're a golfer, make sure you're planning out your week
plan
accordingly.
ahead. So
It's kind of cool, a cool chart because you can almost see the growth of golf
since
in it as well.
since 2016. I mean, it's kind of exploded, really exploded after COVID. So
Which makes sense. That's when I started playing.
yeah, that's that's when a lot of people started
Yeah.
playing golf. So
Yeah, I like that piece.
it's pretty cool. All right, not as fun maybe, but a really good indicator I have for my next one. This is an Xpost by Subu Trade on 4/24, and this is a chart of, I'm going to butcher this pronunciation, but I think it's Zweig. Breadth Trust is on track to trigger today. What does the S&P 500 do next? So I just wanted to give a definition of what the Zweig Breadth Trust indicator is for listeners. So the Breadth Trust indicator is a technical indicator used to ascertain market momentum. It is computed by calculating the number of advancing issues or stocks on an exchange. You take the NYSE, for example, and then you divide the total number of issues advancing plus declining on it, and generating a 10-day moving average of this percentage. It probably sounds like a bunch of mumbo jumbo, but this indicator signals the start of potential new bull markets when it moves from a level of below 40%, indicating an oversold market, to a level of 61.5% within a 10-day period. So this is a rarely occurring sentiment, which carries tremendous importance with market watchers. I would say, kind of in layman terms, and you can correct me a little bit, it's basically when a good portion, a large portion of the market, take the S&P 500, are rising in share value versus declining. So breadth in my world is a lot of the market is doing better or doing well, right?
And this specifically is measuring the difference of breadth.
Correct.
From below 40 to above 61 and a half.
Exactly. So that's a pretty big
Yeah,
move.
it's huge.
It's a really
move.
big
Yeah,
move.
Yeah, so it'd be like almost like just broad market participant as far as on the upside, just kind of knee jerking higher.
Yes,
Yeah.
absolutely. So there's a bunch of instances since 1950s of this occurring. Well, actually, there's not that many. There's only, 14, 15? And it shows the performance of the indices 1 week, 2 weeks, 3 weeks, 3 months, 6 months, 1 year later. 80+% of the time, you can see the chart on our show notes, the market tends to rally quite a bit. Looking at 1 week later, it's up 1.2%. Looking at 1 month later, up 5%, 94% of the time. 6 months later, average 16% growth 100% of the time. 1 year later, almost 24% growth 100% of the time. So I think that's a pretty telling indicator. Nothing's guaranteed in the markets, and things can change, but I think that's a pretty strong signal for the longer term, that I think the market can move higher from where it is, kind of at these slight sell-off numbers.
Yeah, this is another kind of deep statistic that you can use to
provide a little more confidence.
Provide
in
more,
investing.
context as to the bottom, and what it looks like in the future. I think it very well it could work out exactly like these averages are showing up, just based on, if we just take the qualitative story that we're in right now,
Sure.
where we hit the 90-day pause. And this quarter, you can almost just kind of toss out the window.
The administration seems to be softening position on tariffs, position on the Fed. Things are oversold, in my opinion, or oversold.
We had that bump back, right, from the bottom already. And now we have a couple months to kind of work it out and figure out what's next from here.
Yeah,
so if that gets worked out,
6-8 weeks are going to be pretty telling for what the market's going to do. I'm in the camp personally. I think the market's going to move higher. But there's still a lot of uncertainty out there. But I think this is a cool chart, cool stat that gives a little bit of confidence for investors.
Yep, absolutely. Again, should give investors the warm and fuzzies.
Exactly. Again, very good, very good. Okay. Last one I got for you is, I'm very positive today. I've got some positive news going.
I like it.
This is a Barron chart. Barron is another research and article group. It's insider transaction ratios, and this was posted on 4/28. So this chart basically shows whether insiders are buying stock or selling stock. So they have some ratios here. When it's below 12, the ratio signals that there is strength, or it is a bullish market. If it's above 12, it's technically bearish kind of range. Okay. So it goes back and forth, and there's really only two reasons an insider would sell stock or buy stock, right? One, they think it's undervalued. Two, they think it's overvalued. Or they're kind of forced to, and they have to, obviously create some liquidity events for spending, whatever it means.
Yeah.
So
CEOs selling for
I should
vacations.
clarify those. The ratio over 20 is bearish. Readings under 12 is bullish. In the middle is kind of neutral. So we're sitting right around neutral right now. So I think that's another positive sign to see the flip from January, when that ratio was very, very bearish, to where it is now, just a few months later. I think is a very good signal. So in my opinion, it tells me insiders think their share prices are undervalued. So an insider is someone who has non-public knowledge. So think of C-suite participants of a publicly traded company, things like managers, things like that,
vice presidents, directors, things of that nature. Definitely good to see, especially given where we are. I'd really be interested to see this chart through the lens of history, just to see if there's any seasonality to the data, because I kind of wonder with the
end of the first quarter, right?
Yeah, or if you tend to see what would be on the surface level more bearish activity in December, January, just kind of from a beginning of the year,
maybe they got to sell some stock, to pay their tax bill, right?
Right, pay their tax bill, or I know and I can't say this for sure, but I know I've studied or I've seen things of this in the past where it seems like some C-suite members will sell in Q4 for like the holiday season,
that
and
makes
traveling
sense.
and things of that nature.
You see kind of a really big spike between November and December. So I would agree. I'd be curious to see throughout the lens of history going back 20, 30, 40, 50 years. What does this chart look like?
And so I think there's definitely probably some seasonality around it. Also, when you think about earnings season, These insiders have blackout windows, and but the takeaway here, regardless of my curiosities,
it's looking better than it did earlier in the year. Yeah, so it's in my world, it means insiders think their shares are a little bit undervalued, and they're buying, right? Yeah. So that's good.
Absolutely.
All right. You got a couple for us here?
I do. I have one long one and two quick ones.
Cool.
And the long one is kind of jumping back into data and economic data.
You love data.
I do. I love data. So my first piece here is just some considerations on key labor market data. We have the jobs report coming out tomorrow. And it's a big deal, of course, but this piece comes from briefing.com. It's their big picture, and I've referenced this a couple times over the last few months on the podcast. It's a great piece. I encourage listeners to go out and read it. I'm sure you can read it for free. I actually think you can. I'm not going to read the entire thing. I'm going to try to summarize little pieces.
Perfect.
But I am going to read pieces of it. So, for obvious reasons, there will be a lot of attention on the U.S. economy in the coming months. It will be judged through the lens of economic data, particularly the hard data. Shout out to recent conversations we've had about hard and soft data, which also came from briefing.com. I digress. Last week, we discussed why that wait will be hard for the market. It boils down to the time it will take to get a feel for developing trends. 1 month of data does not a trend make, nor does 2 months. At a minimum, it will take 3 months of economic data to gain a better foothold on how the economy is operating in a minefield of tariff bombs. There is one important piece of hard data, though, that remains very much on the economy's side: initial jobless claims. And then there's this big section in the article that kind of explains initial jobless claims and how it can be a better leading indicator relative to the jobs report that we're going to have on Friday.
Right.
In the interest of speeding that section up, I'm going to summarize that section. The unemployment rate is released with the jobs report on the first Friday of every month. It's a lagging indicator, meaning most of the time the market is looking for this data to reflect what has already been priced into the market. Sure. It's hard data, but it's often used more as a confirmation signal.
Right.
Which is why when that data surprises, you'll kind of have that knee-jerk reaction in the markets, because the market's kind of already baking it in. Then you get the hard data, and then based on
if it
misses hugely, the market will kind of reprice really quick, and you'll see it right after the report is released. But again, it's more of a confirmation signal, and it is a lagging indicator. So going back to the article, when it comes to the labor market and its implications for the economy, initial jobless claims are the key labor market indicator because they are a leading indicator. I'm going to pause here and explain that the reason they're a leading indicator is because initial jobless claims are actually released on a weekly basis, so it's easier to get a sense of the trend quicker. Right? And it kind of gives you, again, like a little bit of an insight into what the jobs report might actually show. Back to the article. The value of the initial jobless claims as a leading indicator is wrapped up in the understanding that they are timely. They capture on a weekly basis the number of people filing for unemployment benefits for the first time. Accordingly, a notable jump in initial jobless claims can be construed as a sign of a weakening labor market, which has important knock-on effects for the economy. When people get laid off from their jobs, they won't spend as much since their regular income stream, excluding unemployment benefits, has essentially been cut off. In turn, employed individuals are apt to spend less and save more out of fear that they could also lose their jobs. This is a momentous consideration because consumer spending accounts to close to 70% of GDP. Spending won't grind to a complete halt, but there is a domino effect of reduced spending that includes reduced business investment, reduced construction, and more job losses that weigh further on the economy. Initial jobless claims, therefore, has a lot of cachet as an economic driver and market mover. Things will change, but just remember it will be the degree of change in initial jobless claims, not the unemployment rate, that matters most as a read on the labor market and economic prospects. The encouraging news today is that initial jobless claims are nowhere close to levels seen during recessions. For the week ended April 19th, the 4-week moving average was just 220K, 220,250 to be specific. That is way below the average levels seen during the last 6 recessions. There's a little chart we'll throw up that kind of shows you initial claims average during the past recession periods. And again, reminder, we're right at 220.
I mean, on average, it looks like you about need to double that to be closer to a recession level.
Exactly. Now, I am going to caveat by saying that this morning at 8:30, this data point was released again, and it jumped from 220 to 241.
Okay.
Now, the
Slight
market,
jump, but
the market in response instantly kind of, and this is pre-market we're talking about, of course, instantly kind of fell a little bit off the highs, but it didn't just drop to Armageddon. We just kind of like chopped down, I think, maybe 0.4%, right? And one of the reasons that is because it's like, ooh, could that job report on Friday come in a bit softer, which might spook the market. And so that's what you're kind of seeing. So the article basically finishes by saying, that is where we want to leave things with this week's column. It is a dose of good news amid the tumult of tariff talk, and who doesn't like good news? So a lot of good news on this podcast.
Yeah.
And I think this is another piece. And with all this data and some of the data that we've seen this week, one other piece that I just want to throw out and have listeners really think about and be aware of is, if, let's say, the jobs report comes out on Friday and it's a little weaker than expected, you're going to see some doom and gloom headlines from the major news provider, kind of sparking fear and the economy's falling apart and et cetera, et cetera. But hearing from some key economists over the past 2 days, one of the things that they pointed out is that a lot of this could just be wait and see. So, and it's kind of hard to parse that out in the data. So with the initial jobless claims, okay, it jumped from 220 to 241 this morning, but when you kind of peel back the onion on maybe the ADP report from Wednesday, it seemed more like employers were just kind of maybe not hiring, but just kind of pausing because some of the other numbers were positive.
With the tariffs, right?
Exactly. Yeah, unknown of how things are going to shake out. I mean, just massive amounts of unknowns over the next 3 months. Understandably so, right? This is a massive wrench in the world's supply chain. So even if that number does come in soft, a lot of that, again, that's not a trend. That's just one report.
One time. It could get worked out over the next several weeks.
Exactly.
As more news is digested, we have more certainty on what policy looks like going forward.
Exactly. And there are other pieces of small data that are kind of under the hood, so to speak, of this economic data that we've seen this week, such as personal income and consumer spending. And again, a lot of those, once you peel the layers back, generally speaking, if I have to say, generalize all of it, the economic data is really showing more of a wait and see right now, not an obvious, okay, here comes the pain. Right. It could kind of grow to be that way, but right now I don't think that's what the data is saying. And again, just looking at this chart that we showed you with the recession periods, I think that is proof in and of itself. So hopefully that helps listeners in the event that there is an overly negative headline on Friday.
CNBC is going to say jobless reports are significantly worse, right?
And it could not be. We could have a positive
headlines.
We could have a spicy positive headline. I'm just trying to get ahead of that for listeners. Hopefully, if they listen to that,
take all those headlines with a grain of salt, as always.
This can help. So
perfect. Love that.
My next two pieces are really quick, and they're both on China factory activity, which is just interesting because China released their PMI, Purchasing Manufacturers Index, which is kind of a sign of what the supply chain is looking like, the health of it, so to speak. And it's interesting because I was able to find two pieces that are kind of on the opposite sides of the coin. So the first one here is an Xpost from Bloomberg's Joe Weisenthal. And it says, this is actually a snippet exactly, it looks like, from a Bloomberg article. And it says, China's factory activity slipped into the worst contraction since December 2023, revealing early damage from Donald Trump's tariffs and promoting calls for a speedy policy boost. The official manufacturing purchasing managers index fell more than expected to 49 from 50.5 in March, the National Bureau of Statistics said on Wednesday. The non-manufacturing measure shows activity in construction and services grew less than forecasted. A reminder that with the PMI reports, if you're above 50, it indicates that the economy is expanding in that whatever they're measuring. Mm-hmm. If you're below 50, it indicates contraction. So we're at 49, and this is the China's manufacturing PMI. Mm-hmm. And there's a chart we'll throw up here, and it's a small move lower. You can see
it's kind of been chopping around really since 2023.
It's not super surprising, right? We would kind of expect this to some degree. So that's the first piece. I don't know if you have any comments on that for me. If the next
No, I agree. It makes sense. I mean, obviously, the tariffs are going to, if they're going to impact China more, it makes sense. It's just, again, we have so much uncertainty. So I think a lot of businesses are just pausing. Yeah. They might not be ramping up manufacturing or in China because they don't know what the tariffs are going to look like. That's been the theme I've noticed over the last several weeks, is kind of a pause, a wait and see attitude from the economy, from businesses. Everything's just been wait and see.
Exactly.
And I think that is reflected in this as well.
Yeah, particularly with decision makings as far as, are we going to move?
That's also why
the supply
we're
chain
seeing
and that kind of stuff.
GDP slow a little bit, is because people I'm not going to take on that new business venture, or I'm not going to expand XYZ because I want to wait and see.
Yeah, let's see how this shakes out.
See what tariffs look like.
Yeah, and that
makes a lot of sense, right?
Makes perfect sense. I actually think that's very good judgment on corporate America. So the second part here is, I'm just calling it China Factory Activity Part 2, is an Xpost from Andreas Steno Larsen. He is the CIO of Steno Global Macro Fund. And he says, signs of a rebound in China shipments. What do the big retailers know that we don't know yet?
That's interesting.
It is.
Are they pricing in that the tariffs are going to be lighter, and they're like, or are they trying to get ahead of it?
Or are they trying to get ahead of it? And that's the big question. That's one of the reasons that I want to throw this chart up, because there are other signs that we've seen this week, and the GDP number, for example, where we saw imports surge 41%, that could be a contributing factor. So we'll throw this chart up here, and it shows the container volume departing China for the U.S. And just a quick note on laden container ship tonnage. That just means that the container is full, and there's a valid seal that's been applied to it. So you would expect that all of these things that are shipped around, they're not always full, right? Sure. Sometimes they're a space, or they're empty, and they try in the supply chain to keep them as full as possible. Obviously, it's the most efficient. But that's a perfect world, and a perfect.
Thank you for that. No, I didn't know what that meant. I'm not in logistics, I guess, so that's very helpful.
Yeah, I'm not a supply chain expert either, so I had to look it up as well. So there are two, and I'll also make a note that there was a lot of comments on this post that were just saying, what are you looking at? And you're looking at way too small of a chart. Like look at history.
Yeah, back it out a little bit.
So
it does go from February to April, which is a pretty narrow lens.
It is.
Maybe a little selective data.
It is, and I think this is probably a bit more. If I had to guess, I think this is more of corporate America stocking up on their inventories and trying to basically, hey, we normally carry, let's just keep numbers simple. We normally carry 30 units. While tariffs are paused, I'm going to go out and I'm going to buy
as
triple
much
the
as I
amount
can afford
that I
to.
can essentially fit in my warehouse and basically my overstock that makes sense with the cash I have on hand. I'm going to go out and instead of holding 30 units, I'm going to hold 90 units.
Sure.
And that's just because of the unknowns of what could happen over the next 3 months. And that will help. There's two things that can do for, just think big retailers. Like just think about Walmart as I talk through this example. What they can do over the next couple of months, if they go out and they get more supply, is they can start testing the price increase with consumers just a little bit and just kind of see where the prices break down, in the like kind of stagflationary environment, if that playbook plays out. But if you don't have the inventory, there's not a whole lot you can do.
Sure.
Right.
Yeah.
From that perspective. So I think that's most likely what's happening. I would love it if they know something that we don't know, but
They very well could, but
they could. But I don't think this is, in the grand scheme of things, I don't think this is
It's not that big
bad.
of a move relative to this chart, though.
It's not. It's very small.
It's interesting, but I don't know. I agree. I'd like to see this chart like bump back.
Yeah.
Like 3 years. 3-year chart would be nice to see.
I actually did look at a very long-term chart, and it just looks like a straight down.
Okay. Interesting.
So the long term. So this is really like looking at that straight down and like zooming in, really,
okay.
which is why there's so much kind of backlash on this guy's post. And I shouldn't say so much. There's backlash on every Xpost, but there are a lot of people who aren't,
Gotcha.
don't agree with this necessarily.
Makes sense.
The last piece I'll say when we think about this and think about building up inventories is, I think of that as an appropriate response from corporate America, and probably a good thing from a supply chain management perspective. If you go back and you think about COVID as it pertains to the supply chain, I think corporate America, they learned a lot from that. And so
inventories might keep slightly elevated just in general,
And they learned a lot and they tweaked a lot post-COVID, and I don't think they were probably expecting this test on their supply chain so quickly after COVID, just 5 years later, 4 years later, so to speak. But here it is, and so I do think that they're probably better equipped. The global supply chain in general is probably better equipped
to
navigate
some of
this
these tests,
than they were during COVID, which is one of the reasons why we had that surge in imports, also just to get in appropriate costs in the worst case scenario, right? As it gives them time to basically test their consumer on how much price increases they can push off before they crush demand of their product, that unit, of whatever. So, which I think is an appropriate response, and would, generally speaking, if you just extrapolate that out to the grocery store or Walmart or whatever's in your mind.
Yeah, I think of a Walmart that orders a lot from China.
Right.
Kind of the big box stores, things like that.
It should help kind of provide a bit of a gap before you start seeing empty shelves. And if we can all go back to COVID and think about that, we saw empty shelves.
Yeah. When demand just surges and prices rise.
And they could, and the supply chain was just disrupted.
Literally can't
and
get things in quick enough. Yeah.
Right. So, that's everything I wanted to cover on China. Just some interesting things to consider. But all in all, a lot of good news on the podcast. Hopefully, this makes listeners feel a little better about where we are. And
we've seen some short-term strength in the market over the last several weeks. So we've kind of chopped off that low, especially on the S&P. So it's been interesting to see. We got a few more days, a few more weeks of earnings. So again, I think it'll be another tell on, just the underlying strength of U.S. corporations, I still think is there. I think some tariff news. Take a name like an Amazon that's growing earnings at 20+%.
Yeah.
I think with tariffs, I think they can get through that.
Yeah.
Again, not a recommendation for or against Amazon, just an example.
Yeah.
There's a lot of other, kind of large companies that fall into that same camp. So, I think overall theme podcast today, optimism, which I like. The market tends to go up more than it goes down. So I think if you can't be, what does Matt call them, perma-bears? You can't always be negative. There's going to be some negative periods of times, but I think leaning towards the positive is good. So
absolutely. Well, thank you all for listening to episode 298 of the Independent Advisors Podcast. We will be back with you next week for episode 299.